come to us and talk to us about some financial matters, how we can really acclaim our lives in regards to ownership and buying a home and getting in position. That is a very key thing. So many of us want to be able to buy a home, right? But we might not have the credit score, we may not know where to go and how to go. So he has been attached to some financial institutions, but more than that, he's attached to kingdom, and he's got some kingdom perspectives, and I'm excited about that. So why don't you put your hands together tonight for Minister Troy Smith as he comes, and I'll allow him to introduce.
Well, I guess we're gonna, all right, hallelujah, praise him. Now this is Nicole Jackson. She's part of my team at Regis. A lot of you may not have known what exactly I do, so you're probably like, what does he do? He just be around. To be floating, he's like, yeah, I always wondered that. So I am a mortgage loan originator. I've been in banking for over 10 years now. I did investment banking at first. Then I decided I want to get into a different field and just try to learn more about it because you want to be well-rounded, as Pastor mentioned. And then Nicole works with me at Regis as well. So a lot of people did not know, like the young lady here said, well, you work at Regis? I do. Just about 1 out of 5 people that you may see will have a green card in their wallet. So it's always good to be with the name, be with a bigger brand. So we already pulled. Are we good, David? Did you get that? So we got PowerPoint. So like he said, we're going to be talking about mortgages. Now, is anyone a home buyer here? No? Raise your hand if you're a home buyer. I know you own a home. Okay, then everyone else, if you're a renter, raise your hand. Do you rent? I do. Right now. I just sold my house. I want to keep some money, get a little money, so I can get ready to build the next house. All right, amen, oh yes, and hallelujah. Okay, look, but let's go ahead and get serious about it. So we're going to talk about your road to home ownership. Now, has anyone ever thought about owning a home at all? Maybe thought about it, then what happens? I mean, look, this is going to be a very interactive. Do I need to get down here? Okay, good. You got another mic, so you got a person bringing it around? Good. Okay, so anyone ever thought about owning a home? People say, yeah. What's the reason why you did not start the process of getting home? Go ahead. There she go.
Well, I'm going to speak because I know what I hear in the atmosphere, but I know a fear before is sometimes people are afraid that their credit is not where it needs to be in order to own a home.
Mm-hmm. Can we agree to that? Say amen to that one then. Okay, we agree. Okay, what's another reason? Deacon?
Making sure that you understand with credit score kind of connects the same thing, is making sure your debt to income ratio is right.
Oh, look at that. He been there before. So
oh yeah.
DTIs and all that stuff. Okay. What about, who else? Okay. Yeah, grab me a chair. So I'm gonna be like John C. Maxwell today. Sit in the chair a little bit. No, I don't really. But either way, what else? Is there anyone else? Any other that she has one?
Living in an apartment and yet saving for a down payment on a house.
Okay. Down payment. How much you say? 10%? Do anyone know what it normally costs for a down payment for a home? 20%. But sometimes they don't know because you don't know what your price of the house you're gonna get. We automatically just start to assume, ooh, that's just too much money. Oh, we got another one, okay.
My cousin is afraid to get a home because she's single and she thinks about the maintenance and the upkeep the grass and all of the things that are attached to home ownership. If your water heater goes out, she's afraid of all the responsibilities that come with the home.
That is true, responsibilities. But also she said the key thing, my cousin, but how often do we hear someone else's story and then we just say, I ain't doing it. Ain't what I gotta, I'm not doing that. So before we get started, I want Nicole to introduce a little bit about herself, and then we'll go on to the slide.
Okay. Just like you already said, I'm Nicole Jackson. I've been in mortgage for about 12 years. I started as a processor. I've been an underwriter, and now I'm on the other side. I actually help you get pre-qualified to purchase your home. I help you with your credit and all aspects of that. So we're here to educate. I love what I do. I love to see the end product of you actually receiving the keys. I love to help first-time home buyers. So that's what we're here to help you and answer your questions. And please feel free. We're all family. And sometimes people, I think the biggest thing that holds us back in everything is fear. So don't let fear keep you from your dreams and what you're trying to achieve, okay? All right, fear will kill you.
Will kill you with that voice. Yeah. All right, let's go to the next slide, David. But so what we're going to do today on today's agenda, this is what I want you to, what you will hopefully be learning today is, what are the pros and cons about home ownership? Owning a home, like you mentioned, responsibility is one, because it's different from renting. You know, when some go out to rent, when you rent, hey, you need to get over and fix this. Something leaking, I don't know what it is, something in the wall. Come and get it. But when you own it, you need to fix it. And they might just let it go for a little while. I know that you see that hole in the wall, don't worry about it in the ceiling. It'll be done next month when I get paid. But there's different things. Okay, the next thing would be, what are the basics about mortgages that I need to know before buying a home? We're going to keep it very simplistic, because sometimes I think we just need to keep it simple instead of just talking over someone's head all the time. Number 3, what is involved in the mortgage application process? So those are 3 things we're going to try to make sure we cover today. Not try, we're going to cover it, okay? Next slide, please, sir. So why own a home? Why should you own one? Anyone? Why should you own one?
Because you have the opportunity, once you have, it's not the letter, equity. Once equity is built in the house, you can draw from that equity.
Okay,
So
do we know what equity is? Tell me, Pam, what is equity?
It's money that kind of builds up. Money builds up after you have owned a home for a while. You can use that equity to, hey, buy a new boat. Or,
There you go. You do what
do
you
some
want.
repairs, renovations, and several things, you know?
Correct. So basically, it's as you own a home, hopefully the value of that home increases, is what we're seeing now in Nashville market. So as you pay on a home, what happens? The balance of it goes down, right? So the more you pay on it and the higher value, that difference is your equity. So that's the money that you actually own in your home as a home owner, okay? So they're making a biggest investment in your home by having that equity.
Well, let's get to what we like to know about, and that's the money. Let's go to the next slide, David. Let's go ahead and just compare ownership versus renting. All right? Can y'all see that? Okay, if you can't, it's okay. So we have one side that has homeowner, the other side has renter. All right? So we got the first, and this is all assumption from property value of $110,000. It's just an example. And then the person is paying a mortgage of $800, and the person is paying a rent of $800. So we're going to compare those two. All right? So in regards to the homeowner, in this first year, they paid $9,600 towards their mortgage. Compared to a renter, you paid $9,600 towards your rent. Okay? You go down to the next line where it says, okay, now when you get something with a mortgage, you can actually start deducting. So you start learning more about taxes. You know, so it's more than just about H&R Block and just going to here y'all go, do what you need to do. Now you actually start knowing more about having some ownership in something. See, when you have a mortgage, you're actually able to deduct the interest that you pay a year. I mean, well, a month. For the year, you get to deduct that the interest payment. And then also the tax you pay towards it. So now when it comes down to actually owning a home, you're not only just paying for the house, you got to pay for the land too. So now you actually have ownership in the dirt that you're sitting on top of, when you land on top. So it's more than just going into the building. Like when you go into the apartment complex, which is nothing wrong with renting when you have a plan in place. There's some people that like to rent forever. They don't want the responsibility at all. I don't have to worry about cutting no grass. But guess what? You can own something and don't have to worry about cutting grass either. You follow me? You can actually, see, we got those assumptions that say, man, I don't want that. My cousin told me. Then I got to worry about, no, look, you can live in what they call a condo or a townhouse. You don't have to worry about actually cutting your grass. All right? When you actually pay for that, when you pay for your mortgage, you got the tax that you have. So now you own that, then also the interest that you're paying, because what a mortgage is a debt, an instrument that you have now in connection with the bank. And they actually tied that to a collateral, which would be the home that you live in. That's what a mortgage is. It's the debt that you and the bank agreed to, and they have collateral to your home. Just like a car. Who owns a car? Who has an actual car that's financed? What happened to that car if you don't pay it? You can repossess it. I had a friend of mine call me one day and said, Troy, you're not gonna believe this. Somebody done stole my car. I mean, like, he was pissed. Somebody done stole my car. I can't believe this. Living in Nashville, living in Antioch, I can't believe this. He called me back 2 hours later and said, man, you ain't gonna believe this. They actually came and picked it up. Because he called the police and did all that stuff, called his mortgage people. They called him, said, not mortgage, but his car. Finance people say, hey, man, we had to come and pick the car up because you owed us some money. So the same thing with a house. If you don't pay your mortgage, they will come and say, well, you know, we got an agreement together. You need to go ahead and move out. And sorry, but sorry. You know, not sorry. You got to go ahead and move. We got to sell it to somebody else. Same thing with rent. You don't pay your rent by the 5th, they might give you a little more lead room, but then what happens? Deuces. All right? But then, so let's move over to the renter side, though. Because remember, we just discussed what their own homeowner has, what they can deduct from their taxes. The renter pays $9,600 a year in rent. How much money do you think they can deduct from their taxes? Why? It belongs to somebody else. There's nothing wrong with that. But, you know, now we're going to start getting to the bottom here in a minute. Like, okay, I'm paying $9,600 a year in my mortgage versus my rent. I get to write some of this off. Let's go down to the bottom. After 10 years, after you paid towards your mortgage, you paid $21,000 toward the ownership of your home. After 10 years living in the apartment, how much ownership do you have? Zero. I mean, anyone else agree? You have none. Remember, you rent, you just borrowing somebody's spot for a little bit. So when it comes down to it, in the first year, though, you only spent $1,500 towards your mortgage after you're rolling off all the interest and all the taxes. First year as a renter, you done spent $9,600 towards rent, and that's it. See you next year. Do it again. Y'all follow? With people that's participating, we're going to give y'all some, Nicole was tripping like, we got to give them stuff for talking. So, go ahead, Pastor, that's for you. First lady, that's for you. Here you go, Dan, that's for you too, real. Hey, y'all give it up for your pastors, though, Pam, here you go. Because literally, there you go, boom. Because look, they don't have to do this. But we always talk about community. How many churches done drove by? Even though we're in the school, how many churches done drove by, and it's a whole lot of churches on one street, and the place still look destitute? Nobody's talking. They said, well, we're going to keep praying about it for how long? Because now we're going to start talking about actually empowering the people. I'm just telling the truth. Let's just tell the truth. But let's go to the next slide, though. So we talked about risk. Now you got to talk about the fact that now you got to worry about the roof and the shingle. The shingle done left and blew off from the storm the other day. Who has to fix it when you own it?
We do.
Insurance. There you go. That's what I was looking for. Because now that we done heard our friends and family tell us, you done got that house, and you see old girl's roof, didn't you? But the insurance just ain't got to them yet. They may have to pay a deductible to get started, but guess what? All the stuff you've heard may not be true. Homeownership, there's nothing wrong with homeownership, because guess what? Like I did this earlier this year, or last year. Let me just tell you this. Look, I sold my home to do something called consolidation. I paid off some bills. But since I had equity in the house, I could do that to get ready to put towards the next house that we're going to build. There's nothing wrong with renting when there's a plan in place. So don't feel bad if you rent. You follow what I'm saying? Don't feel bad that you rent, because I try to tell people that all the time, I ain't rent because I feel like I'm throwing money away, but you don't have no money to throw. You try to make it rain on some greens. But I'm just saying, so it's risk to come with it. So the next thing is, are you ready to buy a home? That's the next thing. People always say, I want to get started, I don't have the credit, but you haven't asked me one of the questions. That's what we're here for, to ask those questions. You got something? Go ahead.
I didn't get too far ahead.
Go ahead.
But for example, we're talking about homeownership and purchase.
Mm-hmm.
Now, the market in Nashville has greatly changed in the past 5 years, greatly 10 years.
Yeah.
The reality, the average house in Nashville, Davidson County,
Mm-hmm.
$2.25.
Right.
So how do we look at that? I know that income has to be, it's $80. It used to be a rule that I remember years ago. Let's say if you make $80,000 or $100,000 a year, then times 3 given your credit score, that should be about how much house you purchase.
So do everybody have, you have a phone? Everybody have a phone?
Yeah.
Put your phone out. We're gonna do a quick math right quick. So I want you to put in your income monthly. So you might have to, divide it by 12. Gross. Do gross. Gross meaning disgustingly balling, okay? Put your amount that you got before Uncle Tom, not Uncle Tom, Sam, took their taxes out. Tom and Sam, and Keith, anyone else. Times that by 0.45. I say 0.45 because we don't want to get towards the red line, but 0.45. That lets you know how much your total bills you need to be spending. Then, so for example, if you pay them $500 a month, take $500 from that number you see. Okay, from the top. Take your monthly income before taxes. Just say, you want to do $1,000. If you need to do that, then press the times button. That one that has an X. Then put 0.45. You got it? Okay. Now, what you're gonna do is, say that your total bills is $500. $500. Take it away from that amount. That's how much your total mortgage should be, no more than that.
That's if you do 1,000.
If you, don't just use your money. You don't want to tell it, but if you did 1,000, let me do it right here.
Hello? So if your monthly income, for example, is $3,500 a month. So if you gross $3,500 a month, 45% of that would be about $1,575. So if 45% of that is $1,575, then you subtract out any debt as far as like car note, credit card payments, and it would be the minimum credit card payment that they're requesting. If you have student loan payments, and we'll discuss that. But any payments that you have that you pay monthly that are reported to the credit bureau, you will take that out, and that's what we would say you qualify for as your monthly mortgage payment.
Go ahead.
She had a question back here.
So I did $1,000. That's $450.
So are you saying subtract that from the original 3,500?
Subtract that from the 45%. So you'll take 45% of your income off the top. Then after that 45%, then you subtract your bills. And it's just the bills that are reported to the credit bureau.
And that's credit cards, car notes, stuff like that. Not your light bill.
None of your utilities.
Not your food.
But you should subtract those yourself.
Oh yeah, we're gonna get that because you go right now. Go to regismortgage.com and you can plug in the payment and do all that stuff. So I'm just giving you a quick.
Try to say, and the reason I think this is important, man, because and I won't even say the kingdom, I ain't gonna talk about just church people necessarily, but people in general don't understand how their income debt really works, right? And how to navigate that when it comes to getting ownership or getting a home or buying something, period. I think it's very important that we get to that idea, because as kingdom, we're not just supposed to be funding ourselves, we're supposed to be helping fund other people. So if we get our money or our stuff kind of in the right order, we're now in position to help other people come out of debt, get in a different position.
Yep, that's true. Go to the next slide, Dave.
Can I ask a question real quick? And I heard this, so I just want to know how true it is. That when you pay off a credit card, one thing I used to do in college, because I went crazy, I would pay it and then close it, thinking that I was getting some of that debt away. And now I've heard that you should leave the credit cards open, but at zero balance.
There's a reason why. Go ahead, Nicole.
Yeah. So that's the part that I was going to cover, but I'm glad you have that question. So when you have a credit card, never close it, because what helps build your credit is the history. So the longer you have that card or that loan, it shows payment history. So if it's only 6 months, it's not much to go off of. But if you paid that card off and you keep it open, it shows that, okay, she has a $1,000 Macy's card that she's not even accessing. So that means she has control over her credit. But you do want to use it every now and then to keep it active. You may spend $25 and pay it off. But it just shows activity to help you get those good points at the credit bureau. But never close a card because it is a bad hit to your credit. I know that sounds weird, but you don't want to close it. You want to keep those accounts open as long as possible.
So available accessibility to credit. So think, for example, we're going to take the mic to her, but the accessibility to credit. The bank is looking at the fact that Daniel has accessibility to $10,000. He hasn't used it. I want to give him more money. That's the credit game. Because the people that might need it, they don't get it. The folks that don't need it, please take my money. Now, I know it may seem backwards, but the fact is, think about it from a personal standpoint. You borrowed $10 from me, and you ain't paid me back yet. Your accessibility is now bad. Then you're going to go to Nicole and say, Nicole, let me get $20 till I get paid on Friday. Now, you don't pay her back. You need it, though. I don't want to give you no more money. But the fact is, I give you $10, you pay me back, then you go over here, now your credit's good with me. Now you got $10 available anytime you want it. Anytime you need it, I got you. You go to her and say, hey, I need $20. You pay her back, that's $20. Now you got $30 of available credit because you paid me back. Now I'm calling you and say, hey, how you doing? Did you get paid on last Friday? Do you need $10? I mean, I want to give it to you now. Go ahead.
If you've never had a credit card, is it good that you never had a credit card, or should you have a credit card to show that you do have some type of credit?
Know this, no credit is just as bad as bad credit. I know it's dumb. So look, how many people you know that work on cash alone? I don't need no credit, I got all cash. That's what I do every day, all day. And then they're gonna try to come to me, and they say, can I get $200,000? No, sir. His credit is zero. He didn't need it. He might be good. If you good, go get a little bit of credit. You know, in college, man, you can go to Capital One back in the day and give you a Subway sandwich just to get it. Ain't real good. No, I'm not telling you to do it. I'm just telling you. If you wanted, they wanted to get you some credit, here you go, take his card. But look, guess what? Sometimes when you go into some bad, let me tell y'all this, man. When you go into some bad situation, and you know, when you're grown, you have to go through some things. And when you struggle, go through some things that make you a better person. What James talked about, right? You go through trials of many kind, right? You go through trials of many kind that makes you better. So when you go through that, you know that you can actually go through something else and a bigger issue, but that makes you stronger each time. So look, you get some money, you might have messed up. That's okay. You still live it, right? Get that taken care of, and you go and say, look, I've done this before. Let's start moving forward, and then they actually will start giving you money again. You got to go through something. But no credit is just as bad as bad credit.
I also want to address that too. You don't have to always go out and get a Capital One card or a store card where you're paying high interest. One of the best tools to use is like a secured card, where you might put $250 on this card and you pay it off, but it's your money. So that way you're not paying the interest, and your limit is whatever you make it. So that keeps you in control, but you're also still gaining credit history. Okay.
We're gonna get to it. Look, so y'all can't see this, but if you go to regionsmortgage.com, regionsmortgage.com, and just go to the calculator that will allow you to actually put in some numbers, see what you can actually pay for and afford. But the thing about interest, you know, how people always say, oh, that's interest way too high. If you pay your interest on time all the time, guess your payment on time and off, how much interest is that? Zero. Don't owe nobody nothing. But you're building your credit to look good in the eyes of everybody else. So we're gonna go ahead and move on. Go ahead to the next one. We already talked about what a mortgage was. Anybody had a question about what a mortgage is? All right. What's included in the mortgage? Then we're gonna get to that. Nicole gonna come on up and talk about what's included. You all right?
Yep. So the mortgage just isn't your mortgage payment. So you're not just paying against that interest. You have different components in your mortgage. So like we covered before, you'll have your taxes. You'll pay those monthly. You'll have also your homeowner's insurance. And then if you're not walking in the door with 20% down, guess what you have? Private mortgage insurance. So does anybody know what private mortgage insurance is?
It's a devil. Yeah. But if you take care of what you need to take care of, it's not really that bad.
Not really.
Because it helps you get what you need to get.
Yeah. So actually, private mortgage insurance was placed, and it's on any mortgage company, any bank that you go to that finances mortgages, because what that does is it covers the home in case it is foreclosed. So if a loan, that means you just stop making payments, they had to take over that home. So if that home is damaged, or if the market goes back down, they receive 20% of the value of that home to cover the difference, okay? So it kind of is insurance for the mortgage company or the bank that is financing your home, okay? So you have that payment, so you have your interest, your principal and interest payment, you have your homeowner's insurance, you have your taxes, and the private mortgage insurance. So that's all the components that equal that one total payment. So when you do your calculations on Regions.com, you'll want to add in kind of what you think the taxes are and your homeowner's insurance to kind of give you a realistic payment. And that's how you'll pretty much figure what you can afford also.
So she explained, we're going on through the slides now, she explained what escrow was. Y'all familiar with escrow? I mean, if you don't know, look, this is the time, if you don't know, ask the question. If you feel like, I don't feel like I'm slow, we'll be in the back, and you can ask us then. But I want you all to get just the basics. The difference between ownership and renting. I'm going to tell you the difference between ownership right here. When I go outside my house, you know, there's people that complain all the time. The roads are this. Look at them kids over there standing outside. And look at the, trash all in the yard. But I'm going to tell you something. When you own it, you go pick it up. What are you doing stepping in my grass? Y'all seen Friday? Yeah. When Stanley said, could you please stay off my freaking grass? And we're like, why is he tripping? Stanley be tripping because he owned that. Don't be stepping all on my grass. I don't pay Oscar and them to come and cut it. Oscar's my guy, that's why I said that. I don't pay them to come and cut my grass. No, don't do that. What are you doing? Pick up that trash. Pick it up. Pick it up. Why are you mad? But when you rent, dirty over here. Let me go and get in the house. It's a whole different mentality. It's a mindset. So I want you to understand the difference between ownership and rent. Just think about it in life in general. If you rent a car from Enterprise, you're going to be not that careful when you drive in a bump. You're going out of town to Atlanta. You hit a pothole. Ooh, hope I didn't mess it up. Good thing I got that walk away insurance. You know what I'm saying? Somebody hit your door. Ooh, this ain't my car. This is Enterprise. But when you buy your car, you parking way down the street, out the way. And then you like, why in the world? I'm way across the street. He parked next to me. You more protective. And it's a difference between ownership and actually rent. There's nothing wrong with that, but there's a difference. There's a mentality difference, okay? So we talk about escrow. We talk about, now let's get to the point of pre-approval and pre-qualification. Now, go ahead.
Escrow is simply a savings account for your taxes and insurance. So you'll pay the lender monthly instead of paying annual taxes. So your annual taxes would be due like in December or November of each year. So instead of paying $2,000 writing that check, you're actually paying it monthly. And then what would happen is the mortgage company would mail to Davidson County or Rutherford County, wherever you live, your tax payment. And then also for your insurance, they will mail that annual premium to your insurance agent. So it's actually, I don't care how much money I have, I think I'd always have an escrow account. I don't think I'd want to write that large check. I think it just hurts once a year. So, also that's just insurance that is going to be made.
And I've done it. We rented some property, and we just said, no, we ain't going to escrow it. And then they sent me a bill at the end of the year, $3,000. I should have divided it up. I didn't got that. But so an escrow account really is, in regards to its true definition, is an account that's held by a third party. It's held by a third party where no one can be touching on and play with it. It's actually going to go straight to what it's needed to take care of. In regards to a mortgage escrow account, it's including your taxes and your insurance in one bucket. So when the time comes around to be paid, the bank will pay it for you. So you don't have to worry about it. Y'all get that? So let's talk about the fact of, are y'all getting it so far? Don't go to sleep on it.
Okay. So now we're at the point where what you would want to do.
Put your mic up to your mouth, boo-boo.
Okay, I didn't want to be too loud.
You good.
But okay.
We're at home.
The best thing for you to do and the smartest thing to do, and most real estate agents will not even show a home to you unless you have this one thing. What is it?
Pre-approval letter.
Pre-approval letter. So that's kind of like your passport to look at homes. The reason why that is so significant is because when you show that you have reserve funds at a bank, is that they know that you've been fully pre-approved. So in that pre-approval process, you're going to complete an application. We're going to pull your credit, we will review your income, we'll check your liabilities, and we will tell you what you're approved for. So we'll basically let the real estate agent know that you can purchase this home and you have reserves to pay for the closing costs and down payment of that home. And it's simple as that. He has a question right there.
How long is that pre-approval? How long does that last? How long is
Good question. So when we pull a credit report, it's usually good for about 180 days. But let me tell you a story behind that, because a credit report, I usually always tell my customers that if you don't make any large purchases, then that pre-approval should be good. So if I pre-approve you today and you go buy a car tomorrow, is it still good?
No.
No, because we have to add in that payment, and then I'll say, well, you're no longer qualified for the $300,000 home I just qualified you for. It is very important when you get pre-approved to not use any credit cards, don't make any new purchases, don't take out any new credit. Back in the day when I was a processor, I was working on a loan and I received a credit alert, because when we pull your credit, we're monitoring your credit. So whenever you take out any new credit, it could be at JCPenney to get that 20% off that purchase and you apply for that card. They will send us an alert stating that Ms. Smith applied for a card, and then I'll have to get the credit card, the payment amount, all that, and add it back in and see if you're still qualified. And it is very serious.
I've seen it where someone has actually gone co-sign for somebody for their son. Mm-hmm. We were almost at closing, and that went from $50,000 in their hand from the refinance to $5,000. Because now that payment, even though she don't have to pay the payment, she's now responsible for it.
And I also have a story of that when I was processing. I'll never forget this. We were a week away from closing on a new home for a customer. They were buying about a $350,000 home. I got the alert, and it said that it was at a car, somewhere they bought a car. And so I called the loan officer and I said, I have an alert for a car. I need you to contact them. We need to get the proof of payment. I got the proof of payment, and they were no longer qualified for the home. They lost the purchase of their home because they wanted to purchase a new car with the home. So when we say don't make any new purchases, don't. And just wait till after you close, and then you're able. We don't want to monitor.
They're going to be calling you and emailing you and sending you stuff in the mail much because you got a house.
Yeah.
Everybody, from furniture place to everybody. So it's going to be there.
Exactly.
Go with the 4 C's.
Okay. Okay. So when you go through the pre-approval process, then the underwriter, which we're the loan officers, we send your information to the underwriter. The underwriter will review your credit, your liabilities, your payments, and make sure what we see is correct. So what they're going to look at, that's fine. What they're going to look at is the 4 C's of credit. Can they see that? No. Well, the 4 C's, you're going to have capacity. So the first thing is capacity is your ability to meet that payment. So if, when we were talking about the 45% of your income, so if that debt to income is already above what that product guideline says, guess what? You're not approved. So we stop right there. Capital. So the value in assets and your net worth, not so much as if you need reserves. Does anybody know what a reserve is based on? So the principal and interest of your home, that principal and interest payment of your home, let's say it's $1,000. And if that guideline says you need 3 months reserves, then you need $3,000 in the bank. And that's after you close, after you pay closing costs. Not all guidelines are like that, but what I tell my customers is, please have reserves. Because when you have reserves, you have what we always call a rainy day fund. Because stuff happens, doesn't it?
Is that, when you rent, don't they ask you to have some reserves? Like you take your income and times it by like 3, right? They times just to make sure you can pay it. Same thing when it comes down to a reserve.
Every day. It's a good day when you learn something new. And so the next is collateral. So the collateral you would be using when you get a mortgage would be your what? Your new home. That is your collateral, because if you don't pay on that, what happens? We take it back, right? So the collateral is there, and then your character. And I think this one is number one. The credit score is going to represent it. Character shows is, have you paid your credit cards? Have you paid your bills in the past? So if they show a good payment history, then that's good. That's good character. You got a question?
That's biblical, isn't it?
Yeah, it is.
Good
And I was gonna say, I have a girlfriend that was trying to buy a home. They had the money in reserve, they had everything, but when they checked with their rental history, they had made 3 late payments and they lost the house. So even having the reserve, having the correct credit score, because of the 3 late payments from reported by their person, they would not give them the loan for the home, and they had gone to 2 different banks, and it was the same thing both times.
That's a guideline across the board.
Yeah. I just lost $220,000 loan because that's closing next week.
Yeah.
Wow.
Because he was renting from his dad. And his daddy said, hey, look, let's just go ahead and look, don't worry about paying this month, fix on the house and put it. Unfortunately, that rent has to stay consistent.
So Troy, what is a good amount of time to establish a good credit payment or a good credit payment history in order for the bank to consider you a good credit risk?
12 months.
I was about to say 24. But she said 12.
They look at the last 12 months payment history. You cannot have 1 late within the last 6 months or 2 within the last 12, or you're disqualified. And that's on all programs, all guidelines. Are you saying like installment loans or just regular?
Mm-hmm.
I think they're a little bit they're more forgiving on those, but when it comes to rental history or previous mortgage payments, you cannot be late. That has to be your number 1 payment you make.
So we talk about renting, it's all good until now you talk about a house. Does it make any sense? It's okay, it's okay.
And also, I want to go back to the credit card. Another thing to help your credit card, to help your credit score, is pay all your balances down to 20% of that limit. Make 20% your number to strive to make sure you pay them down to. I know that this time of year, a lot of people are coming out of Christmas, and January and February are the worst credit score months. And I have people that may have come to me previously and had 700 scores. They come back and they're low 6s because they have spent the cards. So as you increase the balance, the credit score will drop if you go over basically 30%. So I tell everybody 20% to kind of keep you where you need to be. And it's not bad. Don't go into shock if your score does lower. If it decreases, it's okay. You'll see the difference if you start paying those cards down. And also, if you use the snowball effect, you'll see the difference.
I'll tell y'all this, the only way you're gonna know is what? You have to apply. Look, go to my website. It's on those flyers I got in those folders. Go to Nicole's website. If you like her better, it's okay. She's cuter than me. But what I'm saying is that, do that, because what happened is we don't know, so we don't ask, we just leave it alone. Well, I mean, my credit already shot. You don't know that. We have programs that go down to a 580. Oh, 580, I might be all right. You might be okay. I mean, but you don't know unless you look. So, yeah, just give me some hope.
That's some hope.
I mean, we all have been here and been there, man. It's okay. The only way you're gonna find out unless you ask. Go ahead.
What kind of credit score should you have to be looking forward to buying a house?
It depends on the situation. Go ahead, Nicole.
Well, like Troy was saying, a 580 is an FHA. So an FHA is going to give you a larger range. They're going to cover more credit history, and that 580 is going to be a little bit more restrictive. But we like for you to have at least a 620. But if you want to qualify for any down payment assistance programs, you need to have at least a 640. A 640 is your cutoff minimum to have any down payment assistance. And the largest right now what we have in effect is THDA, because THDA gives you a larger income to a household income to qualify, okay? So if you have 2 people in the household, you can make up to $85,000. But you want to have at least a 640. Good. Keep on.
I appreciate the question.
Yeah.
We about done just getting like Jesus.
Yeah, we
I
like
came here trying to get
questions.
saved tonight, and this dude over here talking.
We want you to ask questions because that's what we're here for.
Okay, now when we're talking about credit scores, I know 3 or 4 different ones. You got Transunion, Experian, FICO. Which one is the
Equifax is FICO.
Equifax? So, and that's the most important one you should be looking at.
All of them.
All of them. So with mortgage, we pull a tri-merge credit report, which is all 3 bureaus. We use that middle score. If we're pulling for 2 people on the application, we use the lowest of the middle. So it doesn't matter which one. So I know a lot of people use, what is it, Credit Karma. Credit Karma may give you 1 bureau at a time, but that doesn't mean that's the score that we use. That's not what we'll have. A lot of times people will come to me and say, I only have this score, but they'll come to me and I'll still pull their credit, and it may be even higher than the one we use to qualify them on, okay? Just like Troy said, you never know until you actually look at your credit, and if you need help, that's where you can start building and know where to prepare.
Credit score is like blood pressure. They might be good when you checked it. When you check it 5 and last year, like some sport rides or something, it's gonna be sky high. I'm just saying. And it changes. Look, I had a guy, we pulled credit, he had a 620. We pulled credit 5 minutes later, had a 622. It changes. So, you know, look, you get those things with FICO and all those other places, that's all good. But when you come to me, remember though, it's the middle low score, like she said. The middle score. So if you got a 582, a 691, and a 650, which one we gonna go by? The 650. Reggie first. Go ahead, Reggie. Then we got you. Congratulations, Reggie. Look at you.
Appreciate it. Each time, you know, they have a soft hit and a hard hit for your credit, right? So, like, how do you go about finding it out without getting hit just out of the park?
Okay. So, this is what I want to explain. So if you get your mortgage pulled, if you get your credit score pulled by a mortgage company, it is not a hard hit unless you go and get it pulled several different times in different areas. So if someone says, no, this is a soft hit, like when you go to apply for a car, it doesn't matter. It's a hit. A hit is a hit. An inquiry is an inquiry, okay? So I don't think there's a such thing as a soft hit and a hard hit. It's a hit. What really affects people's credit is that if they come and they apply for a house, then you go and apply for a car, then you go apply for furniture, your score will drop, I mean dramatically, because the inquiry looks like you're losing it. You're going everywhere. You're trying to buy everything. But if you stay consistent and you're just not getting your credit pulled several different times, then you're okay. It's not going to be a bad hit.
But in that same vein, the shopping around though, for the mortgage, you would want to look, because when we bought our house, we wanted to make sure we were getting the best interest rate. So we did do a couple within the same days because they expect you to check. Is that?
Right, so you stay within the same realm. So you were looking at mortgages, so it shouldn't have changed that much because it was the same mortgage. So then you'll see a difference. But I'll tell you something too. Once you get your credit score pulled, that's what your credit score is. So you can tell the person, oh, I got a 650. They can run your numbers and tell you what you qualify for. They don't have to keep pulling your credit. Okay.
Okay.
Somebody have a
No,
question?
me. Yeah, I'm here. Right
Oh,
here.
there you go.
Yeah.
Oh, okay.
Livy just wanted to know what age she should start building credit. She just was scared.
When you grown? 18. Okay. Oh, you want a treat? Okay. Yeah, that team is
Seriously, she should start building not just credit, but financial knowledge as early as possible. She can start building financial knowledge right now. She can open a checking account right now and learn how to deposit money and balance her account and make sure when she makes those purchases how to take it away from her balance and know what it means. Because a lot of times the children today, they don't know the true meaning of money because all they use are the cards, so they don't know what it feels like. When I was growing up, all we had was paper money. So when you hand that $5 bill to the checkout, you're gonna get 10 cents back and it hurts. So I knew the value of $1 when I was growing up, but I think starting at an early age, open a checking account at like 12 years old and use that money from, holidays or birthdays and put it in an account and they see their balance grow, okay?
Yes, I agree with you in regards to the checking account. So all my children had checking accounts when they were 13 and they're on debit cards. So like now they Uber eating and everything, And it's all good. I'm okay with that because okay, you earned that money, so now that's how you want to spend it. Oh, okay. But there's limits within that. My question was in regards to putting your children as a co-signer on yours. So I had done that with my older daughter. So her credit score was the same as mine. She had almost a 780 point score.
Make sure you apply with me when you get the house now.
And being that she was 20 at the time, and she has her own job, that stuff, she qualified for a house. The thing is, at the time she said she was scared, but she also didn't have any other credit history. So what do you say to that? So she has the points because she was under my name, but she doesn't have the history. So how do we go about building that?
We do have what we call a non-traditional credit program. So non-traditional credit is when we take any different credit lines that you may be paying on. A credit line can be your utility bills. It could be your rental history. It could be your car insurance. So what we do is get the last 12 months of that payment history and we build from there. A lot of times, I know FHA will allow that, and then we also have an in-house program, the Affordable, which is also 100% financing and 97% financing. We allow the non-traditional credit. So you want to make sure that she also has payments that she's making on her own also. Whether it's her, because most people have cell phone bills, so make sure her name is on that. Her car insurance, make sure her name is on that.
No, she's a part of the family plan.
Yeah,
she
I know. But that's what we'll do is just build non-traditional credit.
We got 2 more slides left. Hang in there with it.
Okay, so I think we're going over mortgage costs now. And a lot of people will ask, as we're going through the pre-approval process, because I think, we're answering questions, but with the pre-approval process, first, of course, you'll fill out the application, run your credit, we go through all your debt, we tell you how much you apply for. So your next question is, how much money do I need at closing? Great question, right? That money is not due until you actually close, but your very first investment that you would make is usually your earnest money deposit. Now that wouldn't be with us, that would be with your real estate agent. What I usually see is about $500, $1,000. So your earnest money is to make sure that the listing agent or the agent that is selling that home takes it off the market. So that home could stay there for you. So usually about $500, $1,000 would be your first investment, okay? Next, you will pay for what we call an appraisal. Appraisal fees are $450 to $475. So if you use a conventional loan, it's $450. If you're going with a government loan, it's $475. And that would be your very first. The reason why you have to pay for that up front is because the bank has to pay the appraiser before he'll even go to the property. Right. Things have changed. So they will wait until we give them their money. All right? So that's your initial investment. And then the last thing, what you'll do is you'll pay at closing. So at closing, during this 30 or 40-day process, we're getting all your documents in for the final closing after you've gone out and got the home, got the contract. Then we'll tell you how much you need to bring to closing. But you will know at the front end about a great estimate of what you need to bring, okay?
Y'all came to my church and spoke to us on Thursday. You said all I need is $3,000 for the down payment. Now you give me this paper that say $15,000. What the heck just happened?
Mm-hmm. So,
what just happened?
So that might have been your down payment, which was $3,000. Then you also have, you may want to get a home inspection. We always tell people, get a home inspection. Yeah. That is not required by the bank, but I would say that if you're buying a home, get a home inspection. That is your protection, okay? So home inspections are usually about like a appraisal, about $450, $400, $450, $500. You got a question? Well, you have your down payment on the home, which is the least amount you can put down is about 3% of that sales price. That's the sales price. Then on the outside of that, you have closing costs. So your closing costs would include your payment to the attorney. You got to pay the title company or the closing attorney to close your home. So that would be your title fees, your recording fees, everything. Yeah, and usually the closing costs, I'd say if you just do like 3% of that sales price, that's on average about what it would be, okay? So you have your down payment, you have your closing cost, and then if you have a realtor, who said that? Commission. Somebody said something about you. So are there any realtors in the audience? So about what is
Congratulations. Got real estate license. We need to talk.
Great. So what's the average commission of a real estate agent?
My wife knows, Agent. What is it, Agent?
It's 3%.
So 3 seems like it's a very popular number. So 3%. So that's going to be your number. So you've got to pay the commission to the real estate agent. So you'll have those fees, and that makes up all your closing costs. Yes.
I have a question.
It's a charger.
We're talking about 3% typically, and again, this is our second home purchase, right? But there's a such thing, and is it profitable to buy from the owner? For sale by owner, do you like get out of a whole bunch of that way?
Yeah. So a FSOB, for sale by owner, what they do is they will sell the home. It's a contract between you and that owner. The only thing that you deal with is a lot of times they're not going to negotiate closing costs for you, or those negotiations have to be between you and the seller. I definitely would say get a home inspection, but you have to know how to negotiate that contract up front. So where a real estate agent is trained to request those items or request those repairs and tie that in up front, you just have to know how to do that. But yeah, you save 3%. You'll save 3% of the sales price. That's money you don't have to pay. But when it's a purchase, the seller pays the real estate agent's commission. So that's not a cost to you.
I was just gonna say, this may be real old school, but have they done away with coming to the table with no closing costs? Because
when I bought my very first home, when I was first teaching, I did not bring any money to the table, and I got my condo.
Yeah.
So have they done away with that program where you?
Well, actually, there is different cases where we do have that. But we do have a 100% financing program. So if you get your home 100% financed, and the real estate agent negotiates the closing costs to be paid by the seller, then of course you're walking in with zero. But as of right now, I mean, the bank does have a program, the first time home buyer.
See your folder.
Yep, where they will pay all of your closing costs, but you do have to make the down payment, which is at least 3%. So Is there a program that pays 100% where you're not walking in with anything? No. But can it be negotiated? Yes. But you just have to be really smart and patient and get that done. Your real estate agent has to really work on your side. So, any more questions?
So what about the programs and things that they have for the down payment assistance?
So, Region's most profitable program is the 100% affordable. That we will pay 100% of your financing. So you don't pay anything down, only thing you have to worry about is closing cost. But there are different guidelines, right, Troy? You have to have at least a 680 for that. So if you have a 680, you qualify, and you also qualify by income. Now, if your income has to be 80% of the HUD median, okay? Now, if it doesn't meet that way, then the property can meet it. So if that home is located in a low to moderate census tract, you qualify.
Guess what? Nashville. There's little pockets in Nashville where homes are $400,000, and you can actually get the house 100% financed.
Yes.
What? I mean, you know what you need to do? You need to go apply, and we'll work all that out.
So about 3 or 4 years ago, when I started to see the rise of cost in East Nashville, I mean, we had homes that normally were worth probably about $120,000, $125,000, and someone would walk in my office with a contract for $380,000. These homes were in a low to moderate census tract. These people were getting 100% financing for the home, and they were only paying sometimes closing costs, but a lot of times the seller would pay that because of, guess what? They're making so much profit, you can have your closing cost. So that's where you have to be really, you gotta pay attention, but also the debt to income ratio on that program is 43%. 43%. So you know how we were calculating the 45? You gotta back it down to 43. All right, so does anybody else have any questions or anything we didn't cover? I know we kind of covered it. It's a lot in buying a home, but really it's truly simple. The pre-qualification is going to be your most important portion of it, is knowing what you qualify for. And if you don't qualify that day, I always tell people, you either walk out with a pre-qualification letter or you walk out with a plan. All right? She had a question back there.
Congratulations, David. They're gonna say no to you.
My question is basically, so you guys pretty much gave all the, I guess, advantages or where you're supposed to start in regards to, you know, trying to buy your first home or whatever. But say you're a person that's the complete opposite of all of that. Where exactly should they start, you know, to begin the actual process?
What do you mean opposite? Like,
yeah, like, you know, the credit score and, you know, having reserves, all of that type of thing. Where exactly, like, what's the first step in regards to that?
Okay, so that's what I'm saying. So if we need to make a plan and we look at your credit, and let's say your credit is 550 and you don't qualify, there's a reason why it's 550. Is there a bankruptcy? Is there a foreclosure? Are there liens? We will know that. Your credit score will tell that. So what we do is we'll look at that and we'll create a plan together. So I have people that are on 30-day plans, 6-month plans, and even next year plans, but they're working towards purchasing their home. They walk out feeling so much better because they have a plan. And also with student loans, you want to be real careful with those. You have to pay your student loans. Amen. They're not going away.
I'm still looking for who they are. I'm praying somebody get to them. But that's a whole other prayer request right now. At the moment, though, some of us are homeowners, and if you could just speak really quickly, because I know we got a limited time, but about refinancing. Because one of the things about home ownership that I found the joy in is that kind of idea, is that you've built up some equity, and now where your house is worth a certain number, right, but you've paid it down, or you've had the equity in your area grow tremendously, and you can borrow against your house without, it being a real big deal, but it kind of benefits you.
First of all, if you're a homeowner and with the rising values, make sure your PMI falls off. Okay? PMI should fall off when you pay your home down to 80%. So make sure you look on your statement, make sure that PMI is not on there. If it is, see if the value of your home versus what you owe is, if it's below 80%, call your mortgage company and ask them, what do you need to do?
Call me.
And he'll take care of it.
We'll do it. Don't worry about who the mortgage person is. Call me on the call.
And try to make sure that you're taken care of. So with the refinance, really good question. A lot of times we have equity in our home. We're not aware of that because you can use that to renovate your home. You can use that to pay off bills. Interest rates are going down. This is a great thing. So right now, what's the average? Have you looked at the rates today? We're at like 4.125, 4.25.
4 is the middle 5s.
We're in the 4s. So a lot of times if you can knock your rate down at least a point, it's gonna make a big difference in your payment. So the first question I always ask people, what is your goal in the refinance? Is it to pay your home off early because we have a program for that? Or is it to give you some relief, financial relief? So if you want financial relief, then that's where we'll look at the term of your loan, we'll look at the interest rate, and we'll look at what we can pay off for you and also put some money back into your pocket. You can go up to 80% of the loan to value to borrow out of your home. So you can go up to 80% of the value, and that's what you can borrow, okay? And that'll kind of tell you what you would get back, cash back. If you take 80% minus what you owe, then you kind of know what you're playing with.
Is it better to do a refinance or a home equity line?
Well, home equity line is just it's kind of like a revolving line on your home. So I have mixed feelings about that. I mean, if you have short-term goals and you know you're going to pay it off and you'll just have it there for emergency purposes, I believe that's okay. Or if you're close to paying off your home and you only owe maybe less than 10 years and you just need that money to help a kid in college, or you just have minor things you need to take care of, then it works, but you must know you're going to pay that off, because what it is it's like a credit card attached to your home. That's how I see it. What about you, Troy?
We talk about that in the back. We got the guy over here is giving us the cue of walk up softly, like I'm trying to close. But look, so thank you all for allowing us to come up here and actually speak to you all about the financial things. Thank you to the STBF family in general, just period. Because look, the last thing I want to leave you all with is vision. Without vision, we what? So right now, if you want to look into getting a home, you got to have a vision to actually get in there. So we'll help you take care of that. You have flyers in there with our email information, all that stuff. Cell phone numbers, just let us know.
Come on, let's put our hands together for them one more time. Listen, I pray that how many enjoyed that? You enjoyed that? Good. This is something, and again, it's a little out of the norm, but y'all know we ain't normal.